Hello everyone, newborn investor here and welcome to another video. After months and months of hype and uncertainty, Robinhood, the icon of retail investing, went public last week. Contrary to expectations, Robinhood had a worse debut. Shares began to tumble as soon as it opened to trading, closing around 8.4% below its IPO price. So what caused the IPO to fail, and should you be investing in Robinhood? In today's video, we are going to talk about it and many more, so make sure to stick around as we are starting right now. Robinhood and their business needs no introduction. Their mission was to democratize finance for all, and Robinhood precisely fulfilled their mission statement. Since inception, Robinhood has been able to attract retail investors, with the majority of them being first-time investors or traders. It's true that Robinhood has made investing and trading more accessible for the common man, but it has also brought with it many risks. So what are they, and are those risks big enough to threaten the very existence of the company? We will get to it in a minute, but before that, if you like the video and find it valuable, please make sure to hit the like and subscribe button. I really appreciate your support as it keeps me motivated to put in the long hours for making these videos. Alright, let's move on. A significant, if not majority, of Robinhood's customers are young, inexperienced investors. Median age of their users is 31, and over 50% of new accounts are first-time investors. This category of investors fueled Robinhood's growth during its early days. Robinhood's customer account size on an average is around $4,000, which compared to traditional brokerage customer accounts are very small. So clearly there is room to grow, but its growth is dependent on their customers' ability to stay in the market without blowing their account. Majority of new traders blow up their account in the first few months and they never go back to the markets. But if Robinhood can do a better job in educating their relatively young customer base, then they could possibly do very well in the long run. Payment for order flow as a practice has become a controversial topic lately. But personally, I don't think it's that evil. When you place an order to sell or buy a stock with Robinhood or Schwab or Fidelity, how does the order get executed quickly? Here is where market makers and payment for order flow kicks in. If not for market makers, you would have to wait for a buyer or a seller to pick up your shares. Market makers offer liquidity by making bets and offers throughout the trading session, and for this risk taken, they profit through the spread between bid and ask. The more volume market makers get, the bigger the profits. This gave way to competition within market makers for order flow. Today, retail brokers are paid for routing orders to market makers, and in case of Robinhood, payment for order flow contributes to 81% of their revenues. Being heavily dependent on payment for order flow is what that piques my concern. Lawmakers are looking to scrutinize the practice of payment for order flow, alleging that the practice does not ensure best price to investors. However, I think for retail investors, payment for order flow is a cheaper alternative to paying $10 per trade in commissions. Almost every broker today makes income from selling order flow, and any regulations to the practice would affect the entire brokerage industry. But with 81% of revenues coming from payments for order flow, I think Robinhood would be the worst affected. Now, with the two prominent risks covered, let's look at the company's valuation. Compared to its brokerage peers, Robinhood's price to revenue valuations are relatively high. As of releasing this video, Robinhood was trading around $37, valuing the company at around $35 billion. This implies that Robinhood is potentially valued at approximately 37 times 2020 price to sales ratio. Comparing it to Schwab, which is trading at around 10 times 2020 price to sales, Robinhood to me looks extremely pricey. At the same time, I think Robinhood's aggressive growth may provide some kind of justification for the high valuation. Now, what's my take on the company? I somehow feel that Robinhood will not be able to sustain its growth rate. The company had a fantastic 2020 with a huge influx of retail investors. Its growth was further fueled by meme stocks like GameStop and AMC. Additionally, I'm concerned about regulatory risks, which can prove to be detrimental. This, coupled with a high valuation, tells me to skip the stock for now. It's definitely not a long-term player for me. Now, I would like to hear from you guys. What do you think about the long-term prospects of Robinhood? Leave a comment below with your answer and I'll be sure to follow up with you. Also, if you like this video and found it valuable, please make sure to hit the like and subscribe button. I really appreciate your support. So until you hear from me again, stay safe and thanks for watching. Bye.